Hey everyone, welcome back to Corporate Decoder, the place where we turn corporate mumbo jumbo into something that actually makes sense. Today's filing is a wild ride involving preferred stock, warrants, and something called an exchange agreement. It's like swapping your old clunker for a slightly less clunky, slightly faster car, but with a lot more zeros involved. And we are diving into a report from Transportation and Logistics Systems Inc., which looks like they are shuffling around their ownership structure in a pretty significant way, potentially impacting everyone from major investors down. Before we jump in, if you like decoding complex corporate stuff, remember to subscribe and also check out our Discord community where people discuss this for themselves. The invite link to join the discussions in the description below. First off, the report tells us that something important happened back in June 2025. It seems the company Transportation and Logistics Systems Inc. made those agreements around June 25th and June 26th. This report is basically an update about that event. The core of this deal involves something called Prove stock. Now, most people know common stock, but preferred stock is like a VIP ticket. It often comes with perks like fixed dividends, which are like guaranteed payouts. In this case, Transportation and Logistics Systems had two kinds of preferred stock, Series E and Series G, on the company reached deals with some of the people who own these preferred stocks, known as exchange holders. The name does give it away a tiny bit, and these deals are called exchange agreements. Essentially, some holders of Series G preferred stock representing about 28% of the total, and accrued dividends from Series E converted to 13,857 shares of Series J preferred stock. Holders of 112,500 shares of the Series G are giving those back to the company in exchange for a different type of preferred stock called Series J, and it also cancels out some unpaid dividends on the old stocks. But that's not all. As part of the deal, these holders are also giving up warrants that allowed them to buy up to 20 million shares of the company's regular stock, also known as common stock. A share of the company's regular stock at a fixed price, so giving them up can be a pretty big deal. Now, these exchanges are not fully done deals yet. It sounds like there are some usual conditions, such as the company actually issuing the Series J preferred stock and no court or government agency blocking the exchange. Also, the company promises that everything they are saying is true and correct and that the common stock is still trading. If these conditions are not met or agreed to be waived, then everything could be called off as well. The company provided samples of the exchange agreements attached as exhibits to the report. These agreements likely contain all the specific details of how the exchange works. Things like legal protections, promises, and responsibilities of the parties involved. These agreement copies are there for anyone to look at. Now, this part is quite important because the company says that they did not register the Series J preferred stock with the Securities and Exchange Commission, also known as the SEC, which in the United States, usually any time one offers new stock, an offering is needed. However, the company says this is okay to do because it fits into exceptions laid out in laws, specifically Section 3(9) and 4AF. 2 of the Securities Act of 1933. These exceptions basically say that some exchanges of securities don't need to be registered, often due to not going through underwriters and similar. So what's the big picture here? Transportation and Logistics Systems is basically restructuring some of its ownership by swapping old preferred stock and warrants for new preferred stock. This can be done for many reasons, but let's step back for a moment. This company isn't exactly a household name. It operates in the crowded transportation and logistics industry, which is incredibly competitive. Think about the giants like FedEx, UPS, and all the trucking companies out there. This exchange could mean they're trying to simplify their capital structure, potentially making the company more attractive to investors in the long run. Less preferred stock outstanding could mean more earnings per share for common stockholders. On the other hand, it could be a way to appease certain investors or raise capital without directly issuing new common stock, which would dilute existing shareholders. Who knows without further financials, but something is happening behind the curtain for sure. It is hard without the financials, but the company's leadership seems confident enough to navigate these risks. For all we know, they are simply betting that the benefits of the exchange outweigh the potential downsides. Alright, that's our breakdown of this filing from Transportation and Logistics Systems Inc. It is definitely an interesting approach to make things happen, but without further financial details, it is hard to assess the impact on existing financials. What do you think of this stock shuffling? Do you think it's a smart move for the company or a risky gamble? Drop your thoughts in the comments below so we know what you are also thinking. If this analysis was helpful, hitting that like button is really appreciated, and also subscribe for more breakdowns of the corporate documentation. Also check the Discord invite link in the description to leave your opinion there and discuss with other people. Thanks for watching and see you next time.